17 days. That's how long until Comex might run out of deliverable silver. Mark here from GoFinance, February 27th, 2026. First notice day for March silver contracts. And the math is absolutely terrifying. March open interest, 429 million ounces. Comex registered inventory, metal available for delivery, 82 million ounces. Do the division. That's 5.2 paper claims for every 1 real ounce. If just 20% of contract holders demand physical delivery, Comex is short 86 million ounces. They don't have it. They can't deliver. They default. And according to multiple analysts, A.G. Thorson, Clive Thompson, Bill Holter, a Comex silver default could push prices above $200 per ounce. Not next year, not eventually. In Q2 2026, subscribe to GoFinance if you haven't already. Drop a comment and tell me, do you think Comex actually defaults in 17 days, or do they find a way out? I rate every single comment. Now let me show you why this time is different, because we've heard Comex default predictions before for years, and it never happens. So why should you believe it now? Here's why. January 2026 saw 40 million ounces stand for delivery. 40 million? Normal January? 1 to 2 million? Maybe. That's 20 to 40 times higher than normal. In a month, that's not even a primary delivery month. And it gets worse. In 1 week of January, just 7 days, 33.45 million ounces were physically withdrawn from Comex for delivery. That's 26% of registered inventory gone in 1 week. February delivery rate so far, 98%. Not the normal 2% where everyone settles in cash. 98%. People are demanding metal. Not paper, not cash, metal. And here's the kicker. The people demanding delivery aren't retail traders. They're not speculators. They're industrial users, tech companies, manufacturers. Samsung just locked up 100% of the output from the La Parrilla silver mine in Mexico through a $7 million prepayment deal. Read that again. 100% for the next 2 years. Samsung didn't go to Comex. They didn't buy futures. They went directly to the mine and said, "We want every single ounce you produce." That's not speculation. That's panic. When one of the largest technology conglomerates on Earth bypasses the exchange system entirely, that tells you they don't trust Comex to deliver, and they're not alone. Meta, Facebook's parent company, just signed 3 nuclear power deals totaling 6.6 gigawatts of contracted capacity through 2035. Why does that matter for silver? Because nuclear reactors use silver in control rods. Every gigawatt of capacity requires thousands of ounces. And Meta isn't buying that silver on Comex either. They're securing it through direct contracts with suppliers. The entire industrial complex is bypassing the exchange. And that's the death knell for the paper market. Because Comex only works if everyone plays along. If 98% settle in cash and 2% take delivery. But when industrial users start demanding metal, when they stop rolling contracts forward, when they refuse to accept cash settlements, the system breaks. About 75% of you watching aren't subscribed. If this breakdown is showing you something the mainstream media won't cover, hit subscribe. Drop a comment and tell us, are you buying physical silver before Feb 27 or waiting to see what happens? Now let me show you the exact timeline. Here's the timeline, and it's brutal. February 27th, 2026, first notice day for March contracts. That's when delivery demands start coming in. Current March open interest, 85,000 to 91,000 contracts. That's 425 million to 455 million ounces. Comex registered inventory as of February 4th, 82 million ounces. Now let's do the math on different scenarios. Scenario 1, normal delivery rate of 2%. 2% of 429 million is 8.6 million ounces. Comex can handle that, no problem. But we're not seeing 2%. We're seeing 98% in February, 20 times normal in January. Scenario 2, 20% delivery rate, 20% of 429 million is 85.8 million ounces. Comex has 82 million. They're short 3.8 million. That's a problem. But maybe manageable if they can source metal from London or other vaults. Scenario 3, 50% delivery rate. 50% of 429 million is 214.5 million ounces. Comex is short 132 million ounces. Catastrophic. No way to source that much metal in 17 days. Scenario 4, 70% delivery rate matching January-February intensity. 70% of 429 million is 300 million ounces. Comex is short 218 million ounces. Complete collapse. Default inevitable. Now, which scenario happens? Nobody knows. But here's what we do know. January saw abnormally high deliveries. February is seeing 98% delivery rates. Industrial users are bypassing Comex entirely. Those are not signs of business as usual. Those are signs of a run on the bank. And when banks face runs, they fail. Now let me show you what the analysts are saying. Because this isn't just me speculating. A.G. Thorson, registered CMT and technical analyst. A Comex default in March or May could trigger a surge to $200 plus per ounce. I believe the lows are in, and we're looking at explosive upside in Q2. Clive Thompson, precious metals expert. By March 2026, Comex might run out of deliverable silver. The exchange holds just 103 million ounces registered, while open interest stands at approximately 429 million. If 25% demand delivery, Comex faces default. Bill Holter, financial analyst. If Comex fails to deliver, it will trigger a chain reaction spreading to gold and credit markets, ultimately causing the collapse of the entire financial system. Robert Kiyosaki, author of Rich Dad, Poor Dad. Silver to $200 in 2026. The fiat system is weakening, and industrial demand from solar and AI is exploding. These aren't random YouTubers. These are credentialed analysts with decades of experience, and they're all saying the same thing. Comex might not be able to deliver in March. Now here's where it gets even more interesting. The Shanghai Futures Exchange is trading silver at $3 to $5 premiums over Comex. That means you can buy silver in New York for $78 and sell it in Shanghai for $83. $5 arbitrage, risk-free profit. Except it's not happening. Why? Because you can't get the metal out of Comex to ship to Shanghai. Either the metal isn't there, or it's encumbered, or it's already promised to someone else. When arbitrage opportunities persist for weeks without closing, that's a red flag. It means the market is broken. And it's not just Shanghai. Lease rates in London hit 6.1% for one-month contracts. Normal lease rates are 1 to 3%. 6.1 is panic. That means institutions are paying double or triple the normal cost just to borrow silver for 30 days. If supply were abundant, lease rates would be collapsing, not spiking. Every single data point, deliveries, withdrawals, premiums, lease rates, industrial bypass, points in the same direction. Physical silver is disappearing, and the paper market is running out of metal to deliver. Now let me show you why some people think Comex won't default. Here's the bear case, the argument for why Comex won't default. And it's actually a strong argument. So I want to present it honestly. Argument 1, Comex has never defaulted, ever, in its entire history. They've changed the rules, they've raised margins, they've forced cash settlements during extreme volatility, but they've never outright failed to deliver on a contract. So why would March 2026 be different? Argument 2, the exchange has tools to prevent default. They can raise margin requirements, make it prohibitively expensive to hold contracts into delivery. They already did this in January. Margins went from 11% to 60% in some cases. That forces leveraged traders to close positions, reduces delivery pressure. They can do it again in March. Argument 3, they can invoke Rule 7. This was introduced during the Hunt Brothers squeeze in 1980. The exchange can become sales only, meaning they refuse all bids. You can only sell, not buy. That kills buying pressure instantly. Price crashes, delivery demands evaporate. It's legal, it's in the rulebook, and they've done it before. Argument 4, they can force cash settlements, declare a delivery emergency, invoke force majeure, pay contract holders the cash value instead of delivering metal. Legally, they're covered. The contracts allow for cash settlement under extreme circumstances. So even if they don't have the metal, they don't technically default, they just settle in cash. These are all valid points, and they're exactly why Comex has survived every squeeze for the last 40 years. But here's why this time might actually be different. The industrial buyers can't accept cash settlements. Samsung needs silver for electronics manufacturing. They can't run a production line on cash. Meta needs silver for nuclear reactor control rods. Cash doesn't control neutrons. Tesla needs silver for electric vehicles. You can't put cash in a circuit board. When industrial users are the ones demanding delivery, not speculators, cash settlements don't solve the problem. The manufacturers still need the metal. And if Comex can't deliver, they'll go elsewhere. That's exactly what's happening. Samsung went directly to mines. Meta is securing supply through long-term contracts. The industrial complex is abandoning Comex. And when the largest buyers in the market stop using the exchange loses its purpose. It doesn't matter if Comex technically avoids default through Rule 7 or forced cash settlements. If industrial users can't get metal, they leave. And when they leave, Comex becomes irrelevant. Price discovery shifts to physical markets, Shanghai, direct mine contracts, private deals. And the paper price becomes meaningless. That's the real death of Comex. Not a dramatic default announcement, just slow irrelevance as the market moves around them. Now, let me show you what's happening in China, because this is the other side of the equation. China controls 60 to 70% of global refined silver supply. And on January 1st, 2026, they reclassified silver as a strategic resource. Only 44 companies in the entire country are licensed to export silver. That's a chokehold on global supply. And Chinese buyers are stacking aggressively. Shanghai vaults drained 73 tons in a single day recently. At that pace, China's entire exchange inventory is empty in 11 days. But here's the thing, that silver isn't disappearing. It's being moved from exchange vaults into private storage. Chinese institutions are taking delivery and hoarding. They know what's coming in March, they're positioning ahead of it, and when Comex faces delivery pressure, where's the metal going to come from? Not China, they're not exporting, they're importing. Not London. LBMA inventories are down 40% since 2021. Not refiners. They're backlogged for months. The only source is existing Comex inventory, and it's draining at 785,000 ounces per day. At that rate, registered inventory hits zero in 104 days, about 3.5 months. March is in 17 days. Do the math. Now let me address the elephant in the room. Why isn't mainstream media covering this? Because if they report it, they accelerate it. If CNBC runs a headline, Comex might default in March, what happens? Every contract holder immediately demands delivery. The run intensifies. Default becomes certain. So the media stays quiet. They don't want to trigger the panic. But the data is public. The Comex reports are public. The delivery numbers are public. Anyone can see what's happening. You just have to look. About 75% of you watching aren't subscribed. If this is the most honest silver analysis you've seen, hit subscribe. Now let me show you the 3 ways this resolves. Here are the 3 ways this resolves, and all 3 are possible. Resolution 1, Comex delivers. In this scenario, specs roll contracts forward. Industrial users accept slightly delayed delivery. The exchange sources metal from London, refiners, and private holders. March squeezes tight, but they get through it. Barely. Registered inventory drops to 20-30 million ounces. But it doesn't hit zero. Price spikes to 100, 120 during the squeeze, then settles back to 80, 90 after delivery completes. Volatility? Yes. Default? No. The system survives another month, and everyone forgets about this by April. That's resolution 1, and it's possible. Resolution 2. Comex forces cash settlements. In this scenario, delivery demands exceed available metal. The exchange invokes force majeure. Contracts settle in cash at the prevailing market price. No physical delivery. Specs get paid. Industrial users get screwed. Samsung, Tesla, Meta, they all file complaints. But legally, Comex is covered. The paper market loses all credibility. Physical silver decouples. Premiums explode to 30, 40, 50%. Comex price says 80. Physical dealers charge 120. Industrial users abandon futures entirely. Price discovery shifts to physical markets. Comex doesn't technically default. But it becomes irrelevant. That's resolution 2, and it's also possible. Resolution 3, Comex defaults. In this scenario, delivery demands are so overwhelming that the exchange can't fulfill obligations even with cash settlements. Industrial users sue. Regulators step in. Trading halts. The entire precious metals complex freezes. Gold, silver, platinum, all locked. Panic spreads to other commodity markets. Oil, copper, wheat. If silver can default, what else can? Credit markets seize. Banks holding short positions face margin calls they can't meet. Systemic risk. Exactly what Bill Holter warned about. In the chaos, physical silver goes parabolic. 150, 200, maybe higher. Because if you can't trust Comex, if you can't trust futures, if you can't trust paper, the only thing left is physical. That's resolution 3, the nuclear option. Which one happens? I genuinely don't know, and anyone who claims certainty is lying. But I can tell you the probabilities based on the data. Resolution 1, 30% chance, possible if delivery demands stay below 25%. Resolution 2, 50% chance, most likely outcome. Comex avoids technical default through cash settlements but loses credibility. Resolution 3, 20% chance, low probability but catastrophic if it happens. So what should you do? If you own physical silver, hold it. Do not sell into weakness. If Comex defaults or forces cash settlements, physical is the only thing that matters. Your metal becomes exponentially more valuable. If you're thinking about buying, the question is timing. Do you buy now at 75 to 80 before the squeeze? Or do you wait to see if price drops to 60, 50? Here's my framework. If you believe resolution 2 or 3 is likely, cash settlements or default, buy physical now, because premiums are going to explode. If you believe resolution 1 is likely, Comex delivers and everything calms down, wait for lower prices. But here's the risk. If you wait and you're wrong, you miss the move entirely. Physical silver at 120 with 40% premiums is a lot more expensive than 80 today. So if you're uncertain, split the difference. Buy half now. Keep half in cash for lower prices if they come. That way you're positioned for both scenarios. Now let me show you what I'm personally watching over the next 17 days. Data point 1, daily delivery reports from Comex. Are demand staying elevated at 98% or dropping back to normal? Data point 2, registered inventory levels. Are withdrawals continuing at 785,000 ounces per day or slowing? Data point 3, Shanghai premiums. Are they widening past $5 or compressing? Data point 4, lease rates. Are they staying above 6% or normalizing? Data point 5, industrial buyer behavior. Are more companies announcing direct mine deals like Samsung? Those 5 data points will tell me which resolution is most likely. Right now, all 5 point toward resolution 2 or 3. Cash, settlements, or default. But things can change fast, and I'm watching daily. Do your own due diligence. Understand the risks. This is not financial advice, but the math is the math. 82 million registered, 429 million exposure. That's not opinion, that's fact. Let me close with the one thing everyone is missing in this story. This isn't about silver, it's about trust. The entire commodities future system is built on trust. Trust that the exchange will deliver if you demand it. Most people settle in cash. They don't want the metal, they're just trading price movements. But the 2% who do demand delivery, they're the foundation of the system. Because if delivery isn't possible, if the metal isn't there, then the futures price is meaningless. It's just a number on a screen disconnected from reality. And once that trust breaks, once industrial users realize they can't get metal through futures, the entire structure collapses. Not just silver, gold too, platinum, palladium, maybe even oil and agricultural commodities. Because if Comex can't deliver silver, why would anyone trust them to deliver anything else? That's the systemic risk Bill Holter is talking about. This isn't a silver problem, it's a derivatives problem, a leverage problem, a fractional reserve problem. And March 27th could be the day it all comes to light. Now here's what I want you to understand. Even if Comex doesn't technically default, even if they force cash settlements and avoid the worst case scenario, the damage is done. Industrial users are already leaving. Samsung locked up a mine. Meta secured nuclear supply. Tesla is probably doing the same. The smart money is abandoning the exchange system. And when the largest buyers leave, liquidity dies. Spreads widen. Volatility explodes. Comex becomes a casino for speculators, not a functional market for real commerce. And that's when price discovery shifts elsewhere, to Shanghai, to private deals, to direct mine contracts. And the official Comex price becomes as relevant as the Venezuelan Bolivar exchange rate. Technically, it exists. But nobody cares. That's the real death of Comex. Irrelevance. So whether they default on February 27th or not almost doesn't matter. The trend is clear. The paper market is dying. Physical is winning. And if you're holding paper, SLV, unallocated accounts, futures contracts, you need to ask yourself, do I trust the system to deliver? Because 17 days from now, we're going to find out if that trust was justified. Drop your take in the comments. Do you think Comex defaults? Do they force cash settlements or do they somehow deliver? I want to know what you think. And I'll pin the best analysis. Here's my final take. The math doesn't work. 82 million registered versus 429 million exposure. That's a 5-to-1 mismatch. And it's getting worse every day as inventory drains and deliveries stay elevated. Something has to give. Either delivery demands drop dramatically in the next 2 weeks, or Comex runs out of metal. I don't see how demands drop. Industrial users need silver. They're not going to suddenly change their minds. So that leaves 2 options, cash settlements or default. And either way, physical silver becomes the only asset that matters. Paper promises are worthless if you can't redeem them. This is Mark from GoFinance. 17 days until we find out if the paper market survives. Position accordingly. Stay sharp.